In Eurozone news, the long-awaited deal with private creditors to cut Greece's debt by some €100 billion is nearly complete. Bankers said the planned bond swap would translate into losses of about 70% for Greek bondholders. Greece still needs to impose austerity measures insisted upon by the International Monetary Fund. The European Union and the IMF have been frustrated by past failures to meet deficit and reform targets, and Greek officials are under tremendous pressure to implement long-delayed reforms and slash spending further or face default. A recent report from Swiss Re estimates over $276 billion in economic losses from earthquakes over the past 2 years, with much of the world remaining underinsured. Swiss Re say that while 80% of losses from the 2011 earthquake in New Zealand were covered, only 17% of losses from the Tohoku earthquake in Japan were insured. Baltz Grollemund at Swiss Re says that while earthquake models are quite accurate in predicting immediate physical damage, secondary loss factors add to the complexity and should be considered more comprehensively. From earthquakes to floods, and after analysing flood data from the UK's Environment Agency, the Association of British Insurers has concluded that thousands of homes and businesses across England and Wales remain at significant risk. The finding supports the ABI's contention that a new long-term solution to the insurance industry's voluntary flood agreement with the government needs to be hammered out. In a statement, the ABI's Otto Thoresen said he was frustrated with the progress of talks with the government, adding we are running out of time and that insurers want to make sure every home has access to affordable insurance. A new Solvency II proposal would force captive owners to further strengthen risk management and governance functions and in some cases inject additional capital. Fitch Ratings believes this may cause some captives to actually re-domicile to non-Solvency II jurisdictions and write EU business through a fronting entity, significantly lowering the counterparty risk capital requirements levied under Solvency II.